So appreciate the opportunity to be here. I'm going to talk about the market. I will ask my colleagues from Mariner who are here just to raise their hand real quick. We've got one in the back and two right here. The reason I'm having them raise their hands is because if you've got hard questions about the market and the economy, they go to them. Easy questions come to me. But what I thought I would do today is I'm going to give you a little bit of a precursor of a market update. It's always easy to go back and look at history, right? Because you look a lot smarter when you're looking back and saying, hey, here's what happened. I am going to give you a little bit of a teaser on our annual crystal ball that we put out every single year. We do that every year in January. You don't have to hear me speak to that. Our firm's chief investment strategist, Jeff Krumpelman, does that. But I don't like to give you a big commercial up here, but I will encourage everybody, if you like a few of the things that you hear today, go onto our website. It's really easy, mariner.com, because on our website, you're going to find a lot of the different accolades that we've received across the industry, which we're really proud of. But we also have this Insights tab, which every single year in January, we put out our annual crystal ball that our clients can listen into. I think last year we had over 3,000 people listen in. And then mid-year, we do our mid-year economic update and outlook. And I think it's somewhat funny because when you start talking about a crystal ball, everybody's like, okay, it's another firm out there trying to predict the market. The reality is, I think we all know that nobody can predict the market, but we're in a business where people pay us to tell them not only what we think is going to happen, but more specifically, how are we going to adapt to some of the potential changes that are on the horizon. So if you go on there, you're going to see a lot of those different things. We put out white papers. Obviously, this year was a big year with the One Big Beautiful Bill Act, even though it wasn't that big of a deal. It was just an extension mostly of the Tax Cuts and Job Act of 2017. But what I thought I would do today is I'm going to give you a little bit of our outlook, but as opposed to just sitting up here and boring you with a bunch of economic slides and data and talking about stocks and bonds, I'm going to talk about some of the things that we do outside the box that I'm pretty sure that at least one, if not all three of the things I'm going to discuss might be new to you as far as ways to invest that you're going to say, well, it's somewhat of a complex subject. That's maybe why I don't invest like that. But the reality is a lot of the things that we do at Mariner, they're complex, but they're not really that complex to understand. And that's my job here today, to let you know some of those things. So without further ado, I'm going to pull this up and I'm going to get this elephant out of the room. That is me. I'm not a pinch hitter, and that's not me from 20 years ago. It's not me when I was in college. That was actually a picture of me 7 years ago when I was at our company headquarters getting our headshots taken. And so the first question I start to get usually is, okay, we got a guy up here talking about investments. He's going through a midlife crisis. I don't think that's the case, although that being said, I do have a 17-year-old daughter and a son that just turned 14. So maybe I am going through one and I don't know it yet. But the reason that picture looks a little bit different, and I'll make the story really short, is I cannot believe it's been almost now 6 years since the beginning of COVID, right? And the world changed for everybody to varying degrees. Go backwards for me, my son was 8, my daughter at the time was 12, going on 13. And the long story really short is my son would spend half of his day going down and spending that time with grandma, my mom. And he came home one day and he said, hey, Dad, I was talking with grandma and she's got a great idea. And anytime grandma's got a good idea, it's usually at Dad's expense. And I'm like, all right, what's that? And she said, well, everybody's watching TV every single day. Everybody's talking about all these horrible things. The world's coming to an end. Armageddon, the virus, nobody can go to school. Everybody's got to wear masks. Dad has to sit in front of a computer to do his work now. Maybe you and him could do something fun together. You guys could let your hair grow long, and then you could donate it to charity, because my son always had a little bit longer hair. So he comes into the house and he challenges me to say, hey, Dad, why don't we grow our hair long together and donate it to charity? So I said, all right, I'll do it with you. I don't know how long I'm going to be on Zoom putting my hair back. So as I sit here today, I'm on round number 3 of donating my hair. My son is already on to round 6. He donated his at the beginning of, I guess that was July, but I think this is probably going to be the last time my hair is this long because he got his hair cut short for football and wrestling. and I think a few of the girls like his hair a little bit shorter. So I don't really think he's going back to the long hair. That was his phase, and he's out of it. But that's why that picture looks different. I am a regional vice president, senior wealth advisor. I've been in the business for over 20 years. And so the things I'm going to be talking about today are things that I'm specifically doing with my clients and the things that my colleagues are doing with their clients as well. So I'm not going to just sit up here and talk about some strategy over here or over there. I'm going to talk about things that we're really implementing at Mariner. Real quick, we are a large national firm. I just like to highlight this. We do have more offices than what we have just here in Utah. We are one of the larger independent firms. We manage over $600 billion in assets. We have over 135 locations. The reason I like to highlight this is I realize, even with one of my colleagues, some of our clients don't spend all of their year in one place. Where I live in Northern Kentucky, a lot of my clients spend half the year in Florida because they like the weather, they get better tax treatment. And then we also have clients that go move to different parts of the country because of their family. So the reality is, wherever you are today, wherever your clients are, chances are we have an office. It's probably in pretty close proximity to wherever they are. The other thing that I'll just highlight right here as well, I'm not going to go through all of our accolades, but I do like to highlight this one. It's our ranking in Barron's. So if you think about Barron's, it's probably the most widely read and respected publication in our industry. Some of you in this room may subscribe to Barron's. And what Barron's does every single year, they rank all of the independent registered advisors across the country. And believe it or not, there are over 15,000 independent firms like Mariner. And then what they do is they publish their list of the top 100. So as you can see up there, we're really fortunate to be in the top 5 nationally over the past 8 years. And then they did this new one, they call it the Mega RIA, and we were ranked number 6 on that list. The reason I just highlight this is because Barron's doesn't even tell us all the criteria that goes into their ranking, but we know 3 things are really important: their client retention rate. Nobody at our firm works on a commission base. So the only thing that we hold our advisors to is if you get a client, keep that client. We have a 99% audited client retention rate. They also then look at the credentials of your firm. Again, if you go onto our website, you're going to see we have every credential and then some in the industry. But then they also look at the growth of your firm. And a lot of times people will say, well, why is growth important? Well, we're in the business of making money for our clients. So if we're making money, our assets are growing, their assets are growing, and chances are we're going to get referrals from people like Larson, from our existing clients. And then we're also the number 1 referring partner for the 2 largest custodians in the country, Charles Schwab and Fidelity. So Charles Schwab and Fidelity, that's where most people custody their assets. We're the number 1 referring office and company to them across the country. So I just highlight this, hopefully for those of you that haven't heard of Mariner, just to give us a little bit of credibility. The next thing that I'll just go through really quick, but I think it's really important. We're going to be talking mostly about the market and investments today, and that's why they're bringing us in here. We're an advisor, but at the end of the day, we do a lot more than just investment management. We are a comprehensive wealth planning firm. And I would tell you, if you only take one thing from what I cover today, if you have not had a financial plan run before, or it's been a long time since you've had a financial plan updated, I would strongly encourage you to start that process. You could reach out to one of our colleagues. We actually do a lot of planning work up front before somebody even engages us as a client. And a lot of times people come to us and say, well, I don't need a financial plan, because a lot of our clients know that they've already won the game, right? They've already got enough money, they're already retired. What do I need to go through a planning process for? Well, when you think of a financial plan, and I'll show you an example on the back end here today, a financial plan, number 1, it does need to confirm, are you on track to meet your goals and objectives? But it should also do 2 other things. If you look down in the bottom left-hand corner, investments. How many times have you met with an advisor or a broker over your lifetime? You meet with somebody for the first time, after 15 minutes, they ask you that wonderful question: what's your risk tolerance? Well, I mean, that's the most loaded question in the industry, right? Everybody loves risk when it's going up. Nobody likes it when it's going down. Hopefully everybody in this room's had an appetite for risk over the past 10 years because that's paid off. But you go back to earlier this year when the stock market was selling off 10% in one day. Nobody likes risk. So by running a financial plan, it actually helps you define that versus asking you what your risk tolerance is. And then above and beyond that, it starts to uncover financial blind spots to varying degrees in all these other areas. I'm not going to go through all of them, but I will tell you that we have our own estate planning team internally. We have estate planning attorneys that can review documents, but they're also there to help clients that are concerned about estate taxes, finding creative ways to insulate their family from estate taxes. Hence is why we also have a trust department. You go across there, you'll see institutional services, and then below that, investment banking. We do have a team internally that works exclusively with business owners. We can help them not only value their business, but we can act as the investment banker as well and help them sell their business. The other thing, tax planning. That's really important. Obviously, we're here with Larson today, and it's great for us to have partners like Larson, but I'll tell you this. Most people that come to us do not get very much tax planning advice at all from their CPAs. They get the preparation, but they don't get a lot of planning advice. They're not looking forward, they're just looking at isolation, they're just filling out the tax return, and ultimately at the end of the day, they're not looking at things that they could be doing today to put them in a better position moving forward. I'll show you an example again later on of some of the work that we do around that. We also have an insurance team. They're really there for people that have policies that maybe, they have a policy they took out a long time ago. It's a whole life policy. They don't really need the protection anymore, but they don't want to lose the benefit. Ultimately, our team can get in and look at it, see if there's different ways for us to monetize that to pass more money on to the next gen. And then we also have ultra high net worth services, and then an independent offering where advisors link up to us. So this is just a high level kind of overview of some of our resources. And then from an investment perspective, we have our own dedicated equity team. We have our own dedicated fixed income team. And then we have our alternatives investment team that breaks out into several different branches. So that's my kind of 5-minute commercial on Mariner, who we are and what we do. And I'm more than happy at the end to answer any questions about those things and what we provide. So let's get into the market outlook, right? And as I said, I don't want to necessarily go back because that's easy to do. But again, people in our industry, they love to fact check you, right? That's why when you turn on CNBC and Bloomberg, you don't get many economists that want to give you their real guidance on where things are going to be in the future because they're scared that they're going to look stupid and somebody's going to come back and say, hey, you said it's going to be here, but it didn't. If you go back, though, and look at our crystal ball, and again, that's on our website from January, you could actually go back and see our past 5 years worth of crystal balls. Our outlook for the market in January of 2025 really has not changed that much at all. This outlook that you see here was going to be the exact same outlook that you saw back in January. Now, I will tell you, if you go look at the street and what different people were projecting for the market, there were varying degrees of where people felt like the market was going to be. But if you go to the midpoint of the year, almost everybody changed their stripes. And why was that? Because we had the tariffs starting to kick in. The market sold off almost 20%. All those people that thought it was going to be a great year said, uh-oh, I better backtrack on that. I'm going to look stupid. And they came down and they lowered their targets. We did not change our targets. Our thesis and our theme for this year, which has played out, was called clear air turbulence. And I think it's somewhat funny because we're dealing with all the issues with the airline industry right now. But clear air turbulence is a real thing. A plane has never crashed from clear air turbulence, but it does cost over $200 million of damage to planes every year. What is that? We're in bright blue skies, seatbelt signs off, you're cruising, and unbeknownst to the pilot and everybody else, the plane kind of drops, starts bouncing around, pilot puts the seatbelt sign back on and says, we're going to try to find clearer air. You hit a turbulent pocket that nobody could see. Next thing you know, you're going up, you're going down, you get to your final destination, but you're kissing the ground when you get there, and you've got an upset stomach. That's what we believed this year would be. We would have a good year, we would get from point A to point B, but it would be a very bumpy ride, primarily because of the unknowns and the wall of worry, which I'll touch on here in a second. People get very emotional, right? The market moves daily on emotion, but it always reverts back to the fundamentals, the valuation, and the technicals. And we remain very steady based upon the fundamental data in the economy and companies and valuations that we believed it would be a good year because of the trajectory we saw, but because of the emotional peaks and valleys that individual investors have, it would be a bumpy ride. So our outlook was, our base case scenario with about a 50% probability was we thought the market would finish around 6,600. I think today it's around 6,800. We put an optimistic case that we thought it might finish around 7,000, which would give us about a 15% return on the market for the year. We're about right in line with where we thought we would be. Now, there was a disappointing case that we put a 30% probability that the market maybe finished around 6,000, which would have been about flat. Not Armageddon, not horrible, but maybe we didn't get much of a return at all. And there was a pessimistic case down here at the bottom that if all of the things on the wall of worry became disasters, maybe it was going to be a horrible year. And people will say, well, do you just throw this number out there? No, it's all based upon data. You can come down here and look at this. Our base case scenario was that the PE multiple of 21 times on the S&P 500 with an earnings estimate of 317 just held steady. There was no reason for us not to be able to get to 6,600. So as we sit here today, we don't have our official crystal ball out yet, but I will tell you, looking into 2026, we actually think the market with about a 50 to 60% probability will finish the year somewhere around 7,700, which would be about a 10%, maybe a 12% increase from where we are today. But we do think it's going to continue to be a very bumpy ride. So if you're one of those investors that thinks I'm looking for a better entry point, you're really concerned, you're really worried, I'm going to show you a few of the things here internally that we are not as concerned as a lot of the things that you'll hear on the TV. So what are these things up here? Fundamentals, valuation, and technicals. Our chief investment strategist, he calls this his yoga chart. You could call it your hiking chart, you could call it your skiing chart, whatever brings your blood pressure down. Because at the end of the day, if you turn on CNBC, you turn on Bloomberg, whatever the outlet is that you tune into every single morning, by about 10 a.m., you're going to be sick to your stomach, and there's no way you're ever going to invest. Right? That's the reality of it. Negative news sells. But our investment team comes back and they analyze this data. And this data comes in continually. We're always updating it. And then we analyze it and we either give it a positive, neutral, or negative. And as we sit here today on the fundamentals and the economic trends, earnings trends, Fed policy, most of those things as we sit here today, we have rated either neutral or positive. You come down to valuation. I'm going to touch on this a little bit more. Valuation on the market. You're going to have a lot of people saying this market is overvalued. We don't think it's overvalued. We actually think it's reasonably valued. And then technical price trends. This was very different. Back in March and April, we actually had a lot of negative signs when the market started to roll over. People were getting nervous. Stocks were advancers and decliners. We saw a lot more decliners. Stocks above their 200-day moving average, there weren't very many. But as we sit here today, the momentum of the market is moving up. And I would tell you, we believe that there's probably more of a likelihood that we have a melt up versus a melt down, because momentum can continue to carry these markets for an extended period of time, and it can usually happen a lot longer than most individuals anticipate. So what about the wall of worry? What about all of these things? And again, you could probably add a few things to this list, but over on the left-hand side, these are the things that most people are concerned about. A softening labor market, valuations, are we in another tech bubble, 2.0, Fed policy. Did the Fed get too aggressive? Are they not being aggressive enough on lowering interest rate? Tariffs. Nobody knows what that's going to look like. Fiscal policy and deficits. War. Looks like we've got one war that's behind us, another one still lingering out there. And then these wild card risk, or risk of rates actually reversing and rising again. A recession, stagflation, labor productivity, profit margins. These are the things, if you turn on the TV, that you're going to hear about every day. And I will tell you, our team internally is looking at all of these things. But if you're going to invest based upon these things over here, you will never invest. Because undoubtedly, if I'm in here 6 months from now, there's going to be 3 things on the left-hand side that are no longer up there. And there's going to be 3 more new things that are up on there. It's going to continue. It's a rolling wall of worry. So what do we focus on? We focus on the things on the right-hand side: economic growth, employment, earnings, interest rate, and credit spreads. And what I would tell you is if these things on the left start to have an impact, You're going to start to see it in the data on the right-hand side. And as I just showed you on the previous page, the data is not bearing out really anything significantly different that would lead us to change our course of action. Now, I will tell you, tariffs is a big one, right? But as we sit here today, we could walk out of here in 5 minutes and there's no tariffs, right? So you're trying to bet on something like either tariffs or a softening labor market where you don't have a clear direction yet. And so everybody wants to get into this ready, shoot, aim. You need to do ready, aim, shoot. Don't get emotional. Make sure you're analyzing the data. And when you start to see cracks on the right-hand side, that's when you want to start to change your overall investment thesis. So what about some of this data? We're going to hear about a job market, unemployment rate. There's no doubt over here on the left-hand side, job growth is slowing. And it's well below the average of 150K 10-year average. You can see that average kind of dotted line and where we are. But if you go over to the far right-hand side, it's not just one snapshot you need to look at when it comes to employment. You got the U.S. unemployment and initial claims. Look at where we are. We're well below the averages on initial claims, and we're well below the historical average unemployment rate. Now, there's no doubt some of the things that are happening with immigration, that's putting a pinch on employment. We need to be able to monitor that. We need to be able to watch it. But again, the data on the right side should not cause most people to be overly concerned. You have to monitor it. It can change overnight, but the reality is just because you get one data point that comes out on unemployment, you shouldn't make a knee-jerk reaction. You need to see a trend that continues to happen over several months, several quarters. The next thing, this is a huge one. Earnings and profit margins. Stock market's trading at all-time highs today. And I have so many people that come in and say, well, market's trading at all-time highs. I don't want to get in while things are high. Well, the reality is the market can be at all-time highs as long as earnings are continue to follow that. But everybody will then talk about, well, what about valuations on the stock market? I hear the S&P 500 is trading at 22 times earnings, and historically it trades at about 16 to 17. Aren't we significantly overvalued? Well, there's one thing to make sure to highlight for you. When you turn the TV on, what's the flagship benchmark that everybody talks about? It's the S&P 500. That is no longer a valid index. There are 7 stocks that represent 35% of the S&P 500 index. They call them those Magnificent Sevens. It's the Teslas, the Googles, the Nvidias. 7 stocks represent 35% of that index. So when those stocks are doing well, the market's doing well. When those stocks are doing bad, the market as a whole looks bad. So when you come over here and you look at some of these different data points, I'm going to flip to this one real quick and I'll come back. Let's look at this. The valuation on the Magnificent Seven. I'm going to try to toggle back and forth here. So here's the S&P 500 PE multiple. You see it over here on the right-hand side, it's 22. That's significantly higher than, that's 16 to 17 times. But let's look at the S&P 500 equal weight. So as opposed to looking at those top 7 companies representing 35% of that index, let's look at all 500 companies across the country equally. What's their average valuation? It's only 17 times earnings. And you come up here and you look at some of these other data points, the Magnificent Seven up here, they're actually trading at almost 60 times earnings. And if you just take out Tesla, they're still trading at 26 times earnings. So there's a few individual companies that are skewing those earnings. When you look at an average PE of 17, that's not overvalued. That's reasonably valued. And I can tell you our investment team, as we sit here today, they're looking at a lot of different companies that are trading at 9, 10, 11 times earnings that they feel like are really compelling buys. So while the growth stocks have had a great run, and everybody's going to talk about them being significantly overvalued, we don't necessarily think that's the case either, because those companies warrant the multiples that they're trading at because they're growing significantly faster than the overall market. Look at other parts of the market, more value-oriented stocks. There's a lot of things that are on sale that people aren't recognizing, and that's why we're more of an active manager. I will just go back briefly to this. People talk about earnings and profit margins, which is part of it. If you look here and people are worried about what the market's going to look like, this line right here, this is the current year estimate for 2025 on the market. We actually believe that it's going to blow out that number over here of about 265. It's probably going to be closer to 280. So when you start to look at earnings growth projected out over the next several years, we actually believe next year earnings growth in the market's probably going to be about 10%. And while you can go out to 2027, we don't like to go out much further than that. 2027 looks to be slightly slower, but probably earnings growth around 7 to 8% on top of 2026. But here's the biggest driver of these earnings. It's profit margins. Look at the profit margins on companies based upon where they were just 5 years ago. Profit margins for companies are out the roof. I could get under the hood and talk about a lot of the ways and reasons that we believe profit margins are so high, but I'm just going to tell you a few of them. AI. Everybody's going to ask you, what's the AI stock to buy? Every company is benefiting from AI. It's the companies that are implementing it and utilizing it the best and most efficiently. Their profit margins are going out through the roof. Labor productivity. Labor productivity is phenomenal. Back in 2020, you'd be lucky to have somebody that could even find the water cooler in the bathroom, right? They were working in their job for 6 months. There was no labor productivity. Now people are on the job a lot longer. They're actually more qualified, and productivity of those individual workers is going up. So for part of that reason, we actually believe that profit margins will continue to at least hold steady. They may not continue at that clip, but we think profit margins will remain pretty high. And then the last thing, I get this real quick, AI-driven capital spending. Look at these numbers. They are staggering. If somebody wants us to talk about, well, is AI real? Is it going to stick around? Is it a fad? It's not a fad. It's real. Look at what AI spending was just 10 years ago versus where it is now. Data center construction spending on just the building alone is over $40 billion, up from $10 billion just a few years ago. So AI spending is continuing to go up. Now there is kind of the twofold to that. If AI continues to go up, the people lose jobs. How do you replace those things? Obviously there has to be some sort of a shift there. Somebody loses a job because of AI. The reality is somebody has to build the data centers. Somebody has to do the work behind the scenes for all of these things. We think those things will balance out. We don't think there's going to be this huge drive that everybody's talking about where you won't need individuals anymore and everybody's going to be working through a computer. But they will be utilizing AI to grow their businesses and be more efficient. So let's kind of shift gears, and somebody can give me a time check. Somebody let me know where we are. Are we about
20 minutes left?
Perfect. That's what I wanted to hear. So as I mentioned earlier, we do a lot with stocks, we do a lot with bonds, we do a lot with cash. But I'm going to talk a little bit about alternative investments because I think everybody in this room would like to hear about something a little bit different than what you hear every day. But I get a little nervous whenever I bring that up when I talk about alternatives because I don't want anybody walking out of here today saying, okay, well, Mariner, that's all they do is alternatives. There's nothing further from the truth than that. The core component of our portfolios consists of stocks, bonds, and cash, but we do want to think outside the box in different periods of time, and we want to look for alternative investments. Now, whenever I bring up alternatives, if I polled everybody in this room and said, what do you consider an alternative investment, and had you write it down, I'm probably going to get 25 different answers, right? Probably going to get private equity, get a hedge funds, commodities. All of those things are true alternative investments. And we have and we will invest in those things when we think the time is right. But you have to think about this first. If you're ever going to get into an alternative asset class or investment, most people's minds go straight to what's my return going to be? And their expectation is this investment's going to be a much greater return than I can get anywhere else so that I can go to the slopes, I can go hiking, and I can brag about my investment that's up 100% while everybody else is making 4 to 5%. And that would be great, but the reality is the first thing that you need to ask yourself is, my alternative asset class, is it going to reduce risk in my portfolio? Is it going to add diversification? We hear about that all the time, right? You got to be diversified. But a lot of times people say, well, I don't even know how to determine whether or not something's reducing risk in my portfolio. It's pretty easy. Are you getting into an asset class that has a very low correlation to your stocks and your bonds? And the way we look at it is if we're going to bring in an alternative asset class, we want something that has a 25% or less correlation to your traditional stocks. So meaning only 25% of the time is it even moving in the same direction. So what I'm going to go through here real quick, and then at the end, I'm more than happy to answer questions or stick around. I'm going to talk about 3 different scenarios in ways that we have been and currently are utilizing alternative investments for 3 different types of clients. Clients that are maybe sitting in a lot of cash. They've been nervous. They've missed out on the big run in the market. They feel like, hey, I'm the guy that every single time I get into the market, undoubtedly it drops 10%. So I'm just never going to get in the market. I'm going to sit in the money market in cash. Maybe you're somebody that has participated in this bull run. You're fully invested. Maybe you got a concentrated stock position that's made a lot of money. Hopefully you got into some NVIDIA. And you say, you know what, I don't want to sell anything in my portfolio because if I do, I got to pay a bunch of capital gains. So I'm just going to continue to do what I'm doing. Or maybe you're on the flip side. Maybe you'd like to get some extra juice on the upside. You want to take part if the market goes up. Maybe you're searching to seek higher income in your portfolio than what you can get in bonds. But you'd also like to have some really hard downside protection if you're wrong in your timing and the market goes down. So I'm going to show you 3 different ways that we can do that. The first one I'm going to start with is something called our cash secured put strategy. And what we're doing here is we're utilizing options, right? And anytime I bring up options, I usually get people that their eyes get glazed over and they're like, okay, here goes a guy going to talk about options. All I know about options is they're really aggressive, they're really risky, I can lose a lot of money. I don't want anything to do with it. But the long and short of it is, in the options world, you can lose a lot of money and it can be extremely risky. But the people that are taking all the risk in the options world are people that are buying options. They're gamblers because they're investing a small amount of money for a short period of time with a hope of making a lot. But if they lose, they only lose a little bit of money. It's like going to a casino and putting $100 down on the roulette wheel. If you win several thousand, but if you lose, you only lost $100. But the other part that never gets talked about are the people that are selling options. Because if you're selling options, essentially what you're doing is you're selling that risk to somebody else, kind of like an insurance company, and you're collecting income while you do that. Essentially, you're collecting premiums. So in this cash secured put strategy, what we're trying to implement is if somebody's sitting in cash, and hopefully you're earning about 4% on your cash. If you're not earning 4%, come talk to us because there's a way that you can earn 4% today on your cash. But you're saying, I'd like to get into the market, but I only want to get into the market if it pulls back maybe 10% or more. Well, in our world, there's an easy way that you can do that. It's called putting in a limit order, right? You have your money sitting in cash and you say, maybe the market's at 100. I don't want to buy in at 100, but I'll buy in at 90 if it drops 10%. You can go in and put this limit order in, depending on who your custodian is, good until canceled for the next 90 days. You go live your life, and ultimately you don't even have to watch the stock market, but if it drops 10% or more, you're going to buy that security at $90 a share. Well, there's 3 scenarios that can happen over that 90-day time period. Number 1, the stock just keeps going up. The stock keeps going up, you didn't make anything, right? It just kept going up, it never dropped to 90. What if it goes down a little bit? Maybe it goes to 95. Well, you still didn't make anything, you didn't lose anything, but it never dropped below 90, you were never buying the security. What if it drops to 85? Well, if it drops to 85, you're going to buy it at 90. Now you have a stock that's down 15%, but you got in when it was down 10%. Well, what if I told you in the options world, we can execute the exact same strategy as a limit order, but we can ensure that you get paid in all 3 scenarios. Whether the market goes up, whether it goes sideways or down a little bit, or if it goes down significantly, you're going to go down a lot less. We can do that by doing something called selling a put. And not to get too technical, essentially selling a put is placing a limit order on a specific stock, but somebody's going to give you money for the right to force you to buy that stock at $90 a share over, let's say, that 90-day time period if it drops. But if it doesn't go down and the order is not executed, you get to keep that money in your pocket, in your hand. And if it goes down below the price of 90. You're still going to have to buy it at 90, but you still collected that money up front, and you're going to be down a lot less in the market. And essentially what we're trying to do with this strategy is allow our clients to still make their 4% in cash, and by selling these options and collecting these premiums essentially every quarter, we're trying to collect an extra 1% to 2% each quarter, but we're willing to buy into the market if it drops 10%. So here's the way it looks. Market drops 8 to 10%, we're going to get into the market. We're insulated with our clients in the first 10% drop every single 3 months. How's it played out for us? We put this strategy in play in 2020 in the middle of COVID when people felt like there was no option. The strategy has averaged for us, and my clicker is kind of a little far over here, the strategy's averaged about 8% since we got into it. It's done exactly what we wanted it to do. It's not geared to try to keep pace with the market. The whole goal is to make 4% on our cash, an extra 1% to 2% each quarter through options premiums. So at the end of a year, we're trying to average an 8 to 10% return, and we don't care what the market has done. That's our goal and objective. Now, it doesn't come without risk, because if the market does go down, we can go down. We're just going to go down a lot less. So I'll highlight up here a negative number for you. In 2022, the strategy was down roughly 3%. And I'm not going to sit here and beat our chest and say, hey, we feel great about being down 3%. But when the market's down 20 to 30, and it was also the worst year on record for bonds, with bonds down 13 to 30, for us to have a strategy that was down 3%, a lot of our clients said this is wonderful. Because you know what? If the market's up 15 and I'm up 8 or 9, I'm good with that. But if the market's down 20 and I'm only down 3, I'm more interested in that downside protection. So if you're looking for a more conservative way to kind of get your cash allocated, this could be a way to do it. Now, on the flip side, I'm going to talk about another strategy that's very similar. We call it our premium income strategy. What if you're somebody that's fully invested? You've got stocks, bonds, cash, mutual funds. You don't want to change what you're doing. You've got a lot of embedded gains. You know, if you sell things, you're going to have to pay a lot in tax. And you say, well, I don't have a lot of cash to go buy things. I don't want to sell things, so I'm just going to ride the wave of the market. Well, we can do the exact same thing that we were doing with those cash secured puts, but as opposed to utilizing cash as your leverage, we're going to utilize a portion of your existing portfolio. So let's say somebody, I'll just throw an easy number out just because it's round. Let's say somebody's got $5 million. We may take $1 million of notional value. That would be about 20% of their portfolio. And we say, okay, you don't have to sell anything, but we're going to look at $1 million of notional value. And what we're going to do is we're going to sell puts on the S&P 500 for $1 million in notional value. And we're going to sell those puts not 10% below where the market is. We're going to go 15 to 20% below where the market is. And we're not going to go out 90 days. We're only going to go out 45 days. So what does that mean? You sell this put, you collect income immediately in your pocket. It's yours to keep. And the only way that you're going to lose out over that 45-day time period is if the market goes down more than 15 to 20%. Well, a lot of people say, well, that doesn't happen very often, does it? No, it doesn't. It'll happen, and it has happened, but it doesn't happen very often. The reality is people continually overpay for risk protection. It's why people are in the insurance business, right? They're worried about that huge drop, so somebody's going to pay you a little bit of money for that protection. So what are we doing with this strategy? No cash, no opportunity cost, and we believe investors consistently overpay for protection. So how much money are we going to get over that 45-day time period? Typically, we're not going to get a lot, right? Because the market doesn't drop that much very often. But if we're overlaying this, I know this is a busy page. Don't try to get caught up in all the numbers. But if you're looking for a strategy to add on to your portfolio that doesn't require you to buy anything, it doesn't require you to sell anything in your portfolio, but you're trying to leverage your existing portfolio to get some extra returns, this strategy has produced positive returns on a monthly basis 90% of the time. Now, it doesn't come without risk because there are those periods of time when the market can go down significantly. Over the past 17 years, you go over to the far right-hand side and you look at the returns by every single year. We've had 3 negative years in the past 17, with the worst being in 2020, start of COVID, the strategy was down about 3%. That's because the market did lose 40% of its value in 45 days in the beginning of COVID. Those people that were gambling, they were finally right. It paid off for them, right? They had that big drop, right? The roulette wheel after 100 spins finally hit for them one time. So the reality is, what are we trying to do? You go to the bottom right-hand corner, you see this 4.29%. If we can add an extra 4% of value on top of a client's existing portfolio, adding on to what they've already done in their portfolio, this can add real dollars. So on a $5 million portfolio, where we're taking $1 million in notional value, and we added this strategy on top of it, averaging about 4.2% over the past decade, has given them about $425,000 of added value in their portfolio, and they didn't have to change anything that they were doing in their portfolio. Over 60% of the clients at our firm utilize this strategy as an overlay, regardless of whether they're conservative, aggressive, or somewhere in between, because you're adding in an asset class that has an extremely low correlation to your portfolio, but it can add huge value. Now, the last strategy I'll hit on, because I probably got about 7 or 8 minutes, give or take, is something called our structured note. Everybody, how many people have heard of a structured note? Anybody even heard of it? We got a few. All right, well, I asked this one because I better get a lot of hands knowing the group. How many people have heard of annuities? Right, we all know annuities, right? Well, why do people like annuities? People love annuities because of the guarantees, right? Well, why do people not like annuities? They don't like them because highest commission-based product in the industry. Usually you're paying about a 5% commission. They're somewhat illiquid, right? Because you got all these surrender penalties and surrender charges. And a lot of times after people have been in them 2 or 3 years, they say, well, you know what? I wish I wasn't in it. I'd have just been better off with a traditional asset. So what we said as a firm, you know what? People love annuities because they like the guarantees, but they don't like annuities because they don't like all of these extra negative things over here, the illiquidity, the cost. How are the insurance companies doing it? I'm sure most people in here kind of understand the basics, but from a high level, all they're doing is going to the large investment banks of the world, the Goldmans, the Citigroups. They're crafting up some sort of investment through the derivatives world that gives them some guarantees. And all they're doing is going into the options world, just like we are with these previous strategies. They're crafting up things that give them upside, downside protection, some stream of income. But the reality is, once it gets to the end user, it's a very watered down product from what was actually put together by the investment banks, because the investment banks got to take out their fee. They cut a little off the top for themselves, a little off the bottom. Obviously, the insurance company has to make some money as well. They may take a little bit off the top or bottom. They also got to take out their fee. The end client's somewhat happy with it, but at the end of the day, the terms aren't super exciting, but they're enough to actually be able to go out and sell the annuity. Well, what we said as a firm, well, what if we went to the investment banks ourselves? And as opposed to going to one, we're going to go to multiple investment banks. We're going to have them compete against each other, and we're going to tell them what we're looking for. We're either looking for higher levels of income, we're looking for extra growth if the market takes off, or we want some hard downside protection. And what we have found, and I'm just going to show you one example of a note that we can get into today, we have found by going to the investment banks, we can get clients all the benefits that they love with annuities without all the significant downside things the negative things that they look at. So just look at the highlights right here. We can go out today and get a 2-year note. This is for somebody that likes income in their portfolio. 2-year note, like a 2-year bond, right? Last 2 years. Anybody know what you can get if you want to go buy a high quality 2-year bond today? What kind of return you're going to get? About 4%, roughly 4. So we got a 2-year note. What are we targeting? We're targeting a 9% coupon. Not 4, but 9. So the first thing most people say is, well, if I'm trying to get 9 versus 4, I must be taking on a significant amount of risk, or I've at least at a minimum got to be taking on double the risk. Well, the reality is in the bond world, people are constantly overpaying for risk protection, right? You're taking on company risk when you go buy a 2-year bond. That company just has to be alive and well for 2 years to make your coupon payments and give your money back at the end. The reality is if you do your homework, you've got about a 99% probability that that's going to happen. But as opposed to taking on company risk and interest rate risk, we're going to take on market risk. So you look at the 3 indexes here, the S&P, the Dow, and the Russell 2000. So the investment banks force us to pick 3 indexes. We try to pick 3 indexes that have a high correlation together. So those three indexes typically move in the same direction. But here's the kicker. We have this principal protection called a 25% geared buffer. So when we get into this note today, if you were to purchase this note, it's going to try to pay you a 9% coupon annually, and it's going to pay that out monthly. So you're going to get 0.75% each month. So let me show you how this works. In month one, the worst performing of those three indexes was actually positive 5%. It wasn't down 25. That's that 25% buffer. So we get our monthly coupon payment. And then the market starts to go on a down slope, but it doesn't go below 25 in month 2, 3, 4, and 5. So we continue to get our coupon payment until month 6. Now one of those indexes is down 26%. That's an extreme downward trend in the market. That would be a bear market. That would be a huge decline. So in month 6, we don't get our income payment. In month 7, the market's still down. It's down 27%. We don't get our monthly coupon payment. But as the market has done every single time, the market has always recovered and gone to new highs. It's just a matter of how quickly it gets there. And it doesn't get there overnight. But in this scenario, the market does start to recover in month 8, but it's still down 18%. But it's above 25, so we resume our monthly coupon payment. So through the course of this year, in this extreme example, the client didn't make 9%, but they made 7.5%. You ask yourself a question. In an extreme down market, you're not tied to interest rates. Would you have rather made 7.5 or would you have rather made 4? And the reality is for a lot of our clients, they're like, boy, I like that, but how often do one of those three indexes go down more than 25%? Here's the number. It's about a 4% probability. So again, just ask yourself this question. Would you rather try to make 9% with a 96% probability of getting all your payments? Or would you rather have a 99% probability to make 4%? And if this 4% down here comes to fruition, maybe I didn't make 9, but I made 8, or I made 7. Still a lot better than what I could have gotten a bond. And for a lot of clients, they say, hey, you know what, a 9% return? I'd be happy with that with my stocks. So this is a way for clients that really want some hard downside protection. They want something that's not tied to interest rates that they maybe see in the fixed income world, the pain they felt in 2022. But they also want something that gives them a really hard buffer on the downside to protect them against the market. This can be a great way to get them into investments. And the last thing that I'll hit on, and I promise I'll be short here in about 3 or 4 minutes, is remember everything starts with a plan. This is an example of a financial plan of one of my clients that came to me in 2019. It was a married couple, and they said, hey, Ryan, you know what? We've heard some good things about your firm. We heard your performance is good. They were a referral from a friend. They said, we're both retiring. We've got 2 kids. One was in high school, one was in middle school. And they said, all we're trying to do is hire an advisor that's going to allow us to grow our assets as much as we possibly can to pass on to our kids because we'll never need this money. And I said, okay, well, let's at least make sure that we go through a financial plan for you. He didn't want to go through a financial plan. If anybody in here has got a client that's an engineer, he was an engineer. He pulled out a stack of spreadsheets this high and said, we've already mapped out our next 10 years of living expenses. There's no need to run a plan. And I said, will you at least humor me and go through the process because I want to make sure that we're not missing any opportunity. So these were the things that we put into the plan. I'll just hit the highlights. We run our plans out to age 95. We also want to factor in the living expenses, obviously, that go into a financial plan. We inflate those living expenses every year. This client didn't want to inflate them, but they're glad they did now because we had no inflation back in 2019. Obviously, we saw massive inflation in 2022. We're usually utilizing a 2% inflation rate. You come down here, you look at their income sources. This is why this client didn't think they needed to run a financial plan because they were going to wait till age 70 to take Social Security and they were getting a pension. You add all of this up, this essentially got to $120,000. They said once we get to age 70, we're never going to have to touch our portfolio. All of our income sources are going to meet our living expenses. We put in growth rates of about 5.6%. We like to put in a modest growth rate, not necessarily what we expect to achieve, but a number we feel like is very conservative and can be achieved over a 35-year time period. We try to factor in taxes as best we can, and then you come down and you look at their liquid assets. And real quick, this client had about $3.3 million in liquid assets, $2 million of that in IRAs. And their plan was they weren't going to touch their IRAs until age 73 when they had required distributions. They were just going to let it ride, and they had about a 10-year window where their income was going to be really low and they weren't going to have to pay hardly any income tax because they didn't have any income. They didn't have Social Security kicking in yet. They didn't have required distributions. They had this small pension and a little bit of dividends and interest. And so when we ran their plan, we estimated under these conservative assumptions, they were probably going to die with about $3.9 million. That was at a 5% growth rate. That was factoring in taxes. And it was also in factoring in inflation, where we had them at age 95 spending like $300,000. They thought that was absurd. And they said, well, I'm never going to be spending that much money. And I sure hope we're making a lot more than 5%. So number one, this is why we didn't need to run a plan. I knew we were never going to run out of money. But what the heck is that number? What's this $3 million in taxes? There's no way we're going to pay $3 million in taxes. And I said, well, why do you think that's the case? He said, well, I've already mapped out our next 10 years. We're only going to be paying about $15,000 in tax, federal tax, a year for the next 10 years because we don't have any earned income. So how are you factoring in if we're only going to spend $150,000 in tax over the next 10 years? You're saying we're going to spend about $2.9 million in taxes in the last 25 years of our life? And my short answer was, actually, I think that number's lower. I actually think you're probably going to spend a lot more. And he said, well, why? I said, well, number one, in the next 10 years, your Social Security eventually will be taxed as ordinary income. You have $2 million in IRAs today, and even at a 5% growth rate, which you think is low, if we don't touch that until age 73, it's probably going to be worth about $5 million. But the problem with that is, at age 73, then the government's going to tell you got to pull out 4%. That's going to be about $200,000. And that 4% is not stagnant. It goes up every single year. So when you're in your 80s, you're taking out 6, 7, 8%. I said, I don't see a situation where you're ever going to be able to get out of the lower tax brackets when you're in retirement because you're never going to be able to control your income. It's just going to go up every year. And he said, well, there's got to be something we can do. And I always tell this to my clients, and obviously we got a lot of tax people in the room. Everybody's got an IRA. But it is one of the biggest tax liabilities you have on your family's balance sheet. It is a horrible asset to have. It's terrible. Because every dollar that grows in there tax deferred, eventually it's got to come out and you got to pay tax on it at ordinary income tax rates. And if you say, well, I'm going to pass it on to my kids, they've got to pull all that money out within 10 years, and they've got to pay tax at ordinary income tax rates. So we say, well, what's the option? Well, we've all heard of the Roth IRA, right? But so many people say, well, a Roth IRA, I can only put a small amount in it. Well, there's something called a Roth conversion, where you can take money from your IRA and convert it over into your Roth, pay tax on it today on whatever you convert over, and move it from a tax-deferred bucket into a tax-free bucket. It can grow for your life tax-free. If you're married, it goes to your spouse, it grows tax-free. You never have to pull a penny out. Then when it goes to your kids, it grows for another 10 years tax-free, and at the end of 10 years, they have to pull the money out, but they never have to pay tax on it. So it's an asset that could grow for 20, 30, 40, 50 years. So in finishing this up, what we did with this client, we ran a scenario where what if we converted $50,000 a year, $100,000 a year, and $150,000 a year? Meaning, as opposed to just sitting on the sidelines and not pulling money out of the IRA, what if down here in scenario C, we pulled out $1.5 million over the next 10 years? You're not required to, but we're going to move it out methodically over a 10-year time period, pay the tax, and shift it over into a tax-free bucket. What impact do we think it's going to have on the plan? And the reality was we estimated that it was going to add about $1.3 million of value to the plan, and it was all going to come in tax savings by reducing their federal tax liability from about $3 million down to about 1.8. And I get the question, well, how come my CPA doesn't have me do it? Well, a lot of CPAs are focused on one thing, right? They want to save their clients every nickel and dime they can that year. They never want to tell their client to pay more tax. But a lot of CPAs don't have the ability to look at somebody's full financial picture and understand whether or not they can pay the tax. Because when we ran the worksheet over here, if they did nothing, they were going to feel really good for 10 years. He was exactly right. They were only going to be paying about $13,000, $14,000 in tax. That was going to be at a 13% tax rate. Versus over here, where we're recommending that they convert this $150,000 a year. We get all of this money out of their IRAs. It takes their tax liability from $14,000 up to $54,000. It takes their tax rate from about 13 or 14 up to 21. Now again, I know we got a bunch of accountants in the room, but if you told your client you owe $14,000 in federal tax, but I've got an awesome strategy for you, but it means you're going to pay $54,000 in tax, what are most of them going to do? They're going to say, you're fired, you're out of your mind. I'm not paying an extra $40,000 in tax. Well, the reality is all they're doing is just putting a Band-Aid over the situation. They're turning a blind eye to a problem that's going to rear its ugly head over here, because this line right here is when those required minimum distributions kick in. And by doing nothing and letting those IRAs mushroom up, when those distributions kick in, we estimate that their tax rate is going to go from about 13 immediately up to 22. And it's going to go up every single year of their life, where at age 95, they're paying 29% federal tax, versus over here, because we get all of this money out of their IRA, they pay a little bit more in tax for the next decade, but their tax rate becomes only about 17 to 18% for the rest of their life. I mean, this is something that we're doing with our clients. And then the beauty of it is we have Larson to be able to work with to say, hey, all we did was run an analysis. This is a no-brainer. This is probably going to add more value to your long-term financial health than whether or not we bought NVIDIA or we bought Google or we bought Procter & Gamble. This is something that we can control. Now we've got to have your CPAs running this worksheet analysis for us every single year to fine-tune it, especially if tax laws change or maybe you're a little bit more charitable oriented. So I just wanted to show you one example of some of the things that we do up front. This was a big eye-opener for a client. Obviously, we've got a lot of tax planners here that I know are going through this analysis, but these are just some of the things that we're doing when we meet with our clients, because typically clients are meeting with us a little bit more than they're meeting with their CPAs. And so if we can uncover these opportunities and then go to the CPA to confirm it and fine tune it, these are great ways to add value outside of investment. So I know I probably went over by about 5 or 7, 10 minutes. Okay, well, there we go. I just saw it getting set up out there. Maybe I'll take, I don't know, 2 or 3 questions, just in general, if anybody's got something that they want to ask. If not, it's okay. And then everybody can grab their lunch and we'll be sticking around here to answer some questions. But I will finish with this. If anybody in this room personally, not just for your clients, but if anybody in this room personally wants to sit down with a member of our team, is willing to share an hour of their time, telling us a little bit about your goals and objectives, maybe letting us look at your investment portfolio, maybe letting us look at a tax return. If you've got estate planning documents, we do a cursory review. We're more than happy to then run a financial plan, see if there's some different tax or estate planning strategies that maybe we think that you should be taking advantage of, quantifying the value of that in real dollars, and then doing a little bit of a diagnostic check on your portfolio and saying kind of here's where you are, here's maybe where we think you should be based upon the output of the financial plan. Here would be steps to get from point A to point B. That doesn't cost you anything. And at the end of the day, if you feel like, hey, this is great, I had a professional look at this, kind of guide me in the right direction, I think I can go handle this on my own, more power to you. But at the end of the day, we've had a lot of clients that go through that process with us and say, hey, you know what? There's some things in here that I think you guys can do that I can't do on my own, guidance that I'm not getting outside. I want to engage you on some level to help me manage this situation. That's what we offer, so feel free to take us up on it. It doesn't cost you a penny, and that's an offer to everybody in this room, regardless of where you are in your career.